So one more video on equity investing. Equity investing gives you very good returns if you are reasonably good at picking stocks, or if you are willing to sit investing in a good fund or in an index. But it also is very difficult when you do individual stocks, because some share which has done extremely well for you over say 5 years or 10 years can give you a gut-wrenching 10x 10 years with returns less than a savings bank account, right? Take dividends into account, it might at best beat savings bank account, maybe reach FD levels. That's where it is. So taking a call when to get rid of it completely or when to hold on to it so that it comes back. I mean, Reliance, Hindustan Lever, I think maybe even Colgate would have all had some absolutely gut-wrenching years when it gave you no returns except the dividends, which was always welcome, because if your cost is low, the dividend looks very attractive, right? If you bought Coal India at 117 rupees, or if you bought Vedanta at 70 rupees, then the dividend is so attractive that it does not matter what prices do. But normally that is not the case for people who keep adding to their portfolio and switching some things in their portfolio. It's not going to be so simple. So how do you handle things with absolutely vomit-inducing or gut-wrenching kind of returns over long periods of time? So you have a share which has done well for say 10 years, and the next 10 years are terrible. So do you hold on for 10 years, or you get out and then come back in? These are all things which you have to answer for yourself. I don't have to answer these for many of the shares that I hold. So for my Colgate, Nestle, Siemens, Cummins and all that, I am not really too much worried on a day-to-day basis, or even on a 3-year basis or a 4-year basis, saying these companies will go fat, right? That does not bother me. So sometimes I am worried that some share which I hold, maybe a GMR Airport, I don't know when to get out and all that. So I look at the price and look at the cost at which I've got it, and I say, okay, I'm reconciled to the fact that it might go through some fluctuation, but I'm just holding on to it. I can afford to hold on to it. I'm not looking at it on a day-to-day basis. So is that the best way to look at it? I don't know whether that's the best way to look at it, but that's the only way I can look at it. I cannot look at my portfolio and say, oh, this time I should have sold Colgate, bought Nestle, sold Nestle, bought HUL, and oh, I should have exited Pfizer. These are all nice things to say in retrospect, but at that point in time, I neither had the skill nor the ability nor the willingness to do it, right? It's much easier to hold on to a basket of well-performing stocks, some people call it the index, or have some other kind of strategy which says, oh, this is the best way to hold on to a share. Is there any one best way to hold on to any portfolio? Yes, you know, some shares of the portfolio will do well and some will not do well, but that you can't do it for individual stocks, because individual stocks will go through these gut-wrenching times when you say, no, I think MRF is a good share, I'll hold on. I think LMW is a good share, I will hold on. I don't care what is happening on a day-to-day basis, on a month-to-month basis, because if you start looking at your portfolio on an hour-to-hour basis and there's a ticker in front of you, you will be tempted to do something which may not be in keeping in line with your nature. Your mind may be very agitated. Remember, it's a time when there is so much information, so much data, so much misinformation, all coming to you and coming to you like a snowball, right? So whatever happens, it's going to drench you. It's going to make it very difficult for you. So with so much information, how does one really act? It's very difficult to say how. So look at it this way, stories will change. At one point in time, one particular line of thought will be the flavor of the month. Everybody will talk about value, everybody will talk about, oh, look at the fantastic dividend yield it is getting, right? So the story will keep changing, but some of the basic fundamentals don't change. A company which has a fantastic 7% kind of dividend yield cannot fall further if people believe that these dividends are sustainable. So some of these stories will change, some of the learnings will not change, right? But you need to understand that there is nothing perfect. We have been in a bull run for too long. It's a horrible time to have started your career as an analyst or as a fund manager, whatever, because every share looks like a good buy because 2 weeks later, 3 weeks later it is up. You reject a share because you think PE of 28 is too high, but you realize that the sector itself is now at a PE of 38. I mean, I've seen this happening in pharma. I mean, how much can you wait and what can you do? Should you just buy the share? Should you say, oh no, I think I will stick to my valuation. I'm more like Charlie Munger and Buffett, and I can sit for long periods of time on cash without worrying. All this happens only when you have a portfolio, right? If you don't have a portfolio, you have to create a portfolio. Then you ask questions which are different. Then you ask, sir, can I borrow money at 9% from my as a personal loan and invest it in the market? Because in the market I heard you get at least 27% return or 25% return. When people do these kind of things, you keep wondering, has anything changed fundamentally in the market? The answer is no. Also, if you are an investor investing your own money, volatility hurts, because volatility hurts me also. I look at my portfolio and say, oh my God, I could have sold this, right? But having 40 years experience, you realize that this kind of talk makes no sense. So then you give up in 30 seconds. Somebody else could give up maybe after half a day and discussing why it should be done and things like that. But think of the leveraged investor, his ability to take his tolerance towards a fall is zilch. I mean, I remember Rakesh Jhunjhunwala once saying that when I see that the market is market is a little weak, I go and pay off my debt, because he used to borrow money, he used to have a leverage position. I mean, most wealth in the world has been created with leverage. If you know how to responsibly leverage, then you're a Mukesh Ambani. If you don't know how to leverage irresponsibly, then you have been taken to the cleaners. But those with leverage have to be far more careful than those without leverage, right? So with individual stocks, volatility is almost guaranteed. It happens to everybody. It happens even if you are a Charlie Munger or a Warren Buffett, because you're in individual stock, right? So almost all your net worth, if not really all, 80% or 90% of your net worth depends on the price of Berkshire Hathaway, and Berkshire Hathaway has fluctuated a lot. It has a high standard deviation. So what do you really do? So somebody asked him that the whole market, investing in the whole market is what something even Charlie Munger and Warren Buffett and even to the extent Graham said. Though Graham did not say it so clearly, he said sometime in 1975 or 76, just before his death, he said buy a basket of stocks. So, I mean, exactly what we would call an index stock, right? So I'll quote Charlie Munger. Somebody asked Charlie Munger, how concerned was he that Berkshire Hathaway, which made most of his net worth, dropped more than 50%. He told the interviewer, and I'm quoting his reply, so I want to just read it out. So when he was asked how much he is bothered about, he said 0. This is the third time that Warren Buffett and I have seen our holdings in Berkshire Hathaway go down, top tick to bottom tick by 50%. I think it is the mixture of long-term shareholding that the normal vicissitudes in market seems that long-term holder has the quoted value of his stocks go up and down 50%. It's not abnormal for him to see that. In fact, you can argue that if you're not willing to react with equanimity to market price decline of 50% 2 or 3 times in your, I think, in a century, you're not fit to be a common shareholder, and you deserve the mediocre returns that debt will give you, which is true, because the people who claim that they want to invest in equity are very scared about the fluctuation that the market gives and say, oh, what can I do when the market falls so much and things like that. If you can't handle this kind of volatility, you should not be in the market, or you should be in the market with a very small or almost negligible portion of your money, not 80% of your money, more like 20% of your money, because you don't know how the market works, right? So for me to think that the market is going to fall is fine. I know the market is going to fall, I only don't know the timing. But if you think that, oh, if you're a professional investor, your portfolio never falls, then just look at Berkshire Hathaway. He's not even a fund manager, he's a business owner, right? There's a big difference. But Charlie Munger says, no, we have no problem with that. That is exactly how your attitude towards the equity should be. Yes, I know equity will fluctuate. Yes, I know there will be a couple of recessions in the next decade, but it does not bother me. The money that I have in equity, in mutual funds, whatever, is surplus, which I don't need for a long period of time. Thank you.